Thank you. This is Hi. This is Sidhartha Dash, or Sid Dash from Chartis Research. I'm the chief researcher at Chartis Research, and today we will be, along with Daniel Schobel, we'll be talking about developments and advances in market consistent scenario generation techniques. Uh, Daniel, if you could introduce yourself, and then we'll be off.
Sure. Thank you very much, Sid. Hello, everyone. My name's Daniel Schobel. I have an actuarial background, and I've been working with economic scenario generators for over 10 years now, both risk neutral and real world, and in a wide variety of insurance and asset management contexts.
Thank you. I think, Daniel, what I wanted to do, what we are trying to do today is look at the changes, the evolution, and some of the challenges as economic scenario generators evolve, and they're getting used in more broader and wider contexts. It's become even more important to understand what are the key issues and challenges as they evolve, if you will. So I wanted to ask you a question around what are the challenges when you incorporate a broader range of asset classes into market consistent scenarios? And linked to that, how do you keep frameworks consistent when you're adding new asset classes, if you will?
Sure. Yeah, that's a great question. Certainly, when building, a market consistent scenario generator, one of the most important things to have of all is kind of observable market data that you're able to calibrate this scenario generator to. So having high quality data that's sufficient for being able to come up with a parameterization of the models that are going to be used to simulate these risk factors, and also taking into consideration any kind of joint simulation dynamics or joint calibration issues which may also arise oftentimes in the definitions of many of the types of models that are used within traditional scenario generators. You may see key drivers appear within multiple models across the ESG. So just as an example, take like risk-free rates as one example. Obviously, we can have stochastic interest rates inside of an ESG, but then when you go into other asset classes that may also be included in your ESG, such as equities, foreign exchange, credit, etc., risk-free rates often turn up within the drifts of these other processes. And so you end up with a joint calibration challenge of having to basically determine how much volatility to apply onto these other processes, in which the drift itself has a stochastic component, which is also contributing to volatility. So this is a very important challenge for building any kind of consistent framework for doing market consistent scenario generation across multiple asset classes beyond just risk-free rates. And then, of course, you also have challenges too, just like the definition of the risk-free rate itself, which can also be a bit of a challenge sometimes, depending on the need of the scenario generation. Whether you need to use treasury rates, a swap curve, or in OIS curves, alternative reference rate curves like SOFR, these types of things.
No, of course, and that's actually become even more complicated and difficult, if you will. And now that moving to one, this thinking about correlations that you pointed out in alternative curves, thinking about one of the inherently challenging asset classes like commodities, does that add any specific complexities, or it's the same sort of joint calibration issues, etc., that are the key challenges there, if you will?
Yeah, so the commodity asset class in particular, you do still have joint calibration concerns here too in building a market consistent ESG. But commodities also come with some of their own unique little challenges for that asset class in particular, and these challenges can vary a bit depending on what the commodity itself actually is that you're trying to model. Like the way in which you would approach the modeling could vary depending on whether you're talking about oil or gold or some other commodity. But in terms of like general practices, yes, like you would still have a joint calibration consideration. You're still going to have some form of a risk-free rate trying to appear in the dynamics of your commodity model, and so certainly you still have to have very careful handling of how you address volatility in building that model, and also as an extension of that, any correlations that you're defining too with other risk factors within the ESG.
Of course, and of course, the sheer volatility of the sheer levels of volatility of some of the individual commodities doesn't help that, and obviously provides additional challenges. Now, moving from that, we've moved from we've had a very significant shift in the interest rate regime, if you will, and so during this interest rate environment and during this transitional period, how are you approaching applying rates, yield curves, historical versus current? Do you see, and what are the key issues here at this point, if you will?
Sure, yeah, absolutely. And interest rates have moved very significantly in recent years, as we've had somewhat rapidly rising inflation, not just in the U.S. but in other economies as well. We've started to see nominal interest rates really tick up quite a bit. In the U.S. now, we're up around 5-ish or so percent across much of the yield curve, and yeah, at these much higher interest rate levels, if we look back at history, this is now starting to look a lot more like a rough historical mean interest rate level. We're no longer trapped down at near zero rates as we used to be, and definitely for building an ESG, this does change things quite a bit too. Kind of in response to being in such a prolonged, low or even negative interest rate environment, there were moves towards all kinds of, different model classes, or introducing, displacement terms or shifts into models to allow rates to be negative or to stay at lower levels, but still exhibit, some like non-zero amount of volatility in any distributions you would be simulating. Whereas, now starting from like a 4 or 5% interest rate level, such modeling complexities are not really as necessary anymore. I would say there's sort of no point for any of these diffusion displacement terms, at least in the current environment now. There's certainly less of a need to have those kinds of features in your model, and so many of like the traditional models, even going back quite a while, like a traditional Cox-Ingersoll-Ross model, or even something with log normal dynamics, even like a Black-Karosinski. These types of models can actually be, quite a bit more appropriate to use now, given the higher level of interest rates that we're at. And certainly in terms of, the ability of the models to fit the curves, I would say definitely that has become easier in the higher interest rate environment. Back when rates were closer to zero or negative, again, that really required like a use of special cases of models or with special extensions on them to accommodate the very extreme environment. So in terms of like a historical context, yeah, I would definitely say the current interest rate environment is a lot closer aligned with historical interest rate levels.
So, I mean, if the markets shift again and there is a similar, do you think you will need to move back to the sort of more complex models, and what do you think will be a trigger, and how do you sort of manage that sort of movement of frameworks, if you will? Where do you do the natural shift, if you will?
Yeah, that's a great question. So certainly, yes, it is possible that, again, in the future, we could find ourselves in another, extremely prolonged, low or negative interest rate environment, which would once again require use of these types of models that would like shift the whole distribution or adjust, lower bounds or diffusion displacement. There's all kinds of little tricks you can do to adjust a scenario generator to accommodate that sort of environment. But as you say, kind of one of the big tricks, though, is how to know when to start employing such things, and that does require some expert judgment. There are certain things that you can check for when you're building the ESG. You can check on your calibration quality, for example. You can apply multiple classes of solvers to it during calibration, and there's various checks you can do on sort of extreme parameter values that might be coming out of your various solvers. If you're finding yourself in a position where say you have 10 different solvers being applied to the same model and same set of market data, and every single one of them is sort of coming up with like very extreme volatility parameters or something like this to accommodate the market data that you've thrown at it. Well, it's like, okay, yes, this could be a clear sign that like the model has reached its limits of what it's able to do for this given for this given market data, and yes, it's time to consider a model change. You have to tweak the model form to get a more reasonable distribution. But there is certainly a level of expert judgment involved in making those determinations.
That's very interesting, and the fact that there is a little bit of an art as well as the overwhelming science, that's another interesting point. So moving from there, the little art in determining transitions to another theme is how do you handle things like credit products? I mean, many of them are fundamentally illiquid, and liquidity is such a shifting definition. How do you handle for that, particularly, for example, long-dated credit products, or which fundamentally may have very low liquidity? How do you handle for liquidity issues, but specifically in the credit side?
Yeah, liquidity definitely can pose a very big challenge, especially for market consistent scenario generation, because ideally you want to have very 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 liquid data, observable data, reliable data when you're building things like credit curves or trying to calibrate a credit model. The more illiquid your quotes are, kind of the less useful information you may be able to derive from such data. Generally, anything that's sort of highly illiquid, the prices that you're observing could have huge risk premia baked into them by whoever's selling the asset. There could be a lot of other sort of problems with using that data. You might find yourself with an unusable credit curve, for example, where there might be some point along the curve that it might imply survival probabilities greater than 1 or something like this. So certainly liquidity does pose a fairly big challenge, and this is where sometimes within the credit space, if it is necessary to include as part of a risk neutral or rather market consistent scenario generator some credit risky asset class, oftentimes you do try to look for kind of the either the most liquid point from which to construct a credit curve, or if you must go to a term structure, you might make some. You might have to apply some assumptions on a term structure of spreads in order to actually have a shape of a credit curve that would actually be amenable to some credit model. Whether you're working with a credit model that's just like a hazard rate model, or if you're in a more advanced class of models, working with, like, say, credit transition models, then you may have even more challenges there, and in also having kind of reliable transition data as well for calibrating those models.
The real world models and real world variables of those which are of interest are changing, and we are seeing the great interest in things like climate risk and climate variables. Do you see what extent can climate risk be robustly incorporated into currently existing modeling frameworks?
Sure. Yeah. So climate risk is something that we have been hearing more and more about. That said, attempting to integrate climate risk factors into a sort of traditional economic scenario generator is still quite a challenging thing to actually do in practice. Many of the models which are used to actually model the climate depend on many different factors and many different types of data. It's not like it's not like some observable asset that has like a traded price or something like this, but instead it could be things like ocean temperatures around the globe at different depths, and ocean currents and things like this. It is something which is technically modelable, but generally not in something like an economic scenario generator. It might be something more that you would see in like an econometric factor style model, where you would have many more factors, and those factors could be sort of very different things, but in like a traditional economic scenario generator where you're generally modeling observable financial risks like interest rates, equities, foreign exchange, and so on, that kind of thing. We generally don't see as much in terms of attempting to squeeze like a climate risk factor in there. Even just trying to do the regression analysis to relate some climate risk factor to, say, interest rates or equities and other things like this, that would be quite difficult to do in practice.
Thank you, Daniel. So I think there's a lot we can discuss on this. This is a really complex and evolving and interesting topic. So we saw today challenges around correlation, challenges around transition points, and the considerable art of deciding when and how to shift your models, as well as the difficulties around credit risk and liquidity challenges, if you will, as well, and finally the overarching challenges with climate risk modeling and integration of climate risk into the overall ESG scenarios, if you will. With that, we conclude. Thank you, Daniel, and we'll now have Oana and Claudio take over the next session, if you will.